Wanted to take this time to kind of address the main question, and that is, why is the market going down? Why has the market essentially been a steady decline from January 1st till present? What has changed in the market from December to now? And so if you don't mind, Derek, I'm going to go ahead and just address probably that's the main question that people might have.
Yeah.
Of course. So the stock market is a forward-looking instrument. And so it doesn't necessarily care about what's going on today. It's more concerned about where the prospects of growth are going to be in a month, and 2 months, and 6 months, and a year down the road. So knowing that it's a forward-looking instrument, what really is driving the market right now is the interest rates. And not necessarily the interest rates are rising or declining right now, but the prospect of rising interest rates in the future. So let's backtrack a little bit. If we go back to the fourth quarter of 2021, the Federal Reserve, which is in the United States, that's the central bank, that's the central authority on monetary policy. The Federal Reserve hinted at the fact that they would likely see 2 to 3 interest rates increases in 2022. So why do they do that? Why do they want to raise interest rates? Well, they're paying attention to inflation because the Federal Reserve essentially has a dual mandate. And that dual mandate is it wants to keep maximum sustainable employment, and it also wants to keep the price stability in control, meaning that it doesn't want the prices of the goods that we buy to rapidly rise or rapidly decline. They want relative price stability. The way that they control the price stability or the inflation rate is through interest rates. And if the economy is running too hot and we have inflation getting out of control, well, then the thing that it does is it raises interest rates. The reason it raises interest rates is, and so why does that work? Well, because it makes the cost of business become a little bit more expensive. So if Derek, you and I make widgets and we want to go to the bank to get a loan because we want to expand our widget business. Well, if interest rates are rising, it makes it, number one, more difficult to get the loan. Two, we would have to ask the question, do we produce enough widgets to pay for the interest if it's a rising interest rate? So the Federal Reserve will intentionally try to cool the economy off in periods of high inflation to bring that inflation back down under control. And it will do the same if we hit a rough patch. So anytime that we are, the economy is becoming sluggish, or if we're entering a recession, the move that the Federal Reserve does is that it decreases interest rates because it wants to make the cost of business cheaper. It wants businesses to go out there and reinvest in themselves, to hire people, to run a marketing plan, to build a building or buy more equipment. So why am I saying this? The fourth quarter of 2021, the Federal Reserve said, we see ourselves raising interest rates 2 to 3 times in 2022 to kind of rein in this inflation. So since then, there are some big banks that have come out and they thought, I don't know if 3 interest rate hikes is going to be enough. Goldman Sachs came out and said, we anticipate 4 interest rate hikes in 2022. And then JP Morgan, who is the CEO of Chase Bank, said, I could see as many as 7 rate hikes in 2022. So that's where we're at right now. The market is a forward-looking instrument, and it's trying to, without knowing exactly how many interest rate hikes are going to be there, it's trying to price in what that is going to be.
Yeah.
And so,
sorry. No, go ahead and finish your thought.
So I think that's what we're at right now. This volatility that we're seeing is the market is anticipating the worst. It's anticipating way more interest rate hikes than we anticipated. And so we'll find out if I'm right or not. There gets to be a time, volatility is neither good or bad, right? Volatility is just the market trying to find its correct level of where it's at. We don't want it to get too high. When it gets too high and it's not supported by something underneath it, by the data that supports rising, then that becomes a bubble. We also eventually get into what's called oversold territory, which means the market's too pessimistic. And you begin to look around and you see companies that you love to own a year ago are now at their lowest point as they have been over the past 52 weeks. So it becomes buying opportunities. And investors look around and they say, oh, the market is oversold at this point. Things are too cheap. And they begin buying again. The selling is reversed by buying, and then you see the rise in the market again. And we saw this. Anybody who was invested in March of 2020 saw this. We had a rapid sell-off when the stay-at-home orders were issued, and we were concerned how long this was going to be. Were we going to be, would the economy be shut down for 3 weeks? Would it be shut down for 3 months? Would it be shut down for a year? And then once we saw that things were coming back and that businesses were opening back up, the market recovered pretty quickly. So it was definitely in oversold territory in March and April of 2020. And I think we're nearing that point now. We'll see if I'm right or not. Just because the market is oversold does not necessarily mean that it's going to turn around right away. It could stay in oversold territory for a period of time. But what makes me believe it's an oversold territory is just to look at some of the stocks out there. Some of these high-flying stocks that are reporting amazing growth numbers, and nothing has changed with them as a company. They're still the same company, producing the same products to the same people who can't get enough of them. We're seeing these at a point again where you'd have to go back a year or even 2 years in some cases to be able to buy them as cheaply as you can buy now.
Yeah, I think the main point there that I wanted to expand on was the point that volatility is not good or bad. Like if you use volatility as a reason to buy or not to buy, it's probably not the best metric to look at, because if you look at a company like Amazon, who is one of the staples of the American economy, there's been times in its history where it's lost 80% of its value in a relatively short amount of time. So if you just look at volatility, you would say Amazon is a bad investment. But if you look at the fundamentals of the company, it's like you would conclude the exact opposite.
Yeah, and as a company becomes more mature,
Or an asset,
yeah.
any asset.
But yeah, as an asset or as a company becomes more mature, you tend to see less of that volatility. So, for example, NVIDIA is a company that you and I both love, and Crosby Advisory loves, and we recommend it as a growth stock. It's seen quite a bit of volatility here in the past month. That doesn't make it a bad investment. It just means that, and I think this goes back to any time that you're investing in the stock market. I think there's some tools that you can put in place that make you act appropriate for the time. The number one tool is to remember your time horizon. When do you foresee needing this money to create income for yourself? Or when do you foresee needing this money to buy a vacation home, or whatever the reason was that you intended to invest? And if your time horizon is 3 years, 5 years, 10 years down the road, what happens now has no impact on that. And again, I would take you back to March of 2020. We ended up finishing the year in 2020 up significantly. So that decline that happened in March had no bearing. And actually, you would make the case, actually, maybe that decline spurred the growth that happened going forward. So number one, we want to keep our time horizon. If we're invested for 3, 5, 10, 15 years down the road, I think we want to be buyers at this point in time. The other thing to remember is the allocation. So if I look at, I can't speak for all investors because I don't know exactly who's on this podcast and if they are clients or not, or if they just picked it up as informational pieces. But if you look at the Crosby Advisory clients, most of them are not 100% stock in their portfolio. They own gold, they own real estate, they own bonds, they own commodities, they own other asset classes. And the media, its attention will be on stocks because, let's face it, they are probably the most exciting to follow. But if I look at the average portfolio, so the S&P 500 since January 1st is down roughly about 10% to date. The NASDAQ is down roughly about 14%. But if you were to take the average Crosby Advisory client, whether they're in a moderate strategy, a moderate high, aggressive, we would see a percentage that is less than that. And that's because we own other asset classes, other assets that are, if you look at gold right now, gold is holding its ground. Commodities have done well through this whole inflationary period. So there's things in this account that are rising or holding their ground as stocks are declining, which is the reason why the account as a whole does not experience the full brunt of the U.S. stock market.